And we're back with another episode of Pure Perspectives. I'm Clark Alexander. I'm sitting down with Willis Richardson. Willis, how you doing?
I'm doing good. Doing good.
Good to hear. Good to hear. Reminder everybody, subscribe, smash that like button, leave us a comment. We're very grateful for your engagement and your conversations, and it definitely has led to some other ideas from a content perspective. Today, we're going to dig into the differences between an FHA loan and a conventional loan. We're going to go through some of the features of each, and then stick around to the end because we're going to talk about the one thing that is going to impact your pocketbook the most if you're considering which way to go. So why don't we start with just the definitions, Willis? What is an FHA loan, and then we'll talk about what a conventional loan is. Let's start with
Yeah.
FHA.
Yeah. So FHA is a loan that's backed by the government that helps people realize that American dream of home ownership. So it's targeted at first-time home buyers. It's there to also help people with lower credit scores get into a home, people that don't have as large of down payments to get into a home, and it overall widens the net for who can qualify for getting into a home. It's a great loan product. It helps a lot of people that wouldn't be able to go the conventional or traditional route of getting into a home, get into a home. Conversely, you have conventional loans. Conventional loans are more traditional loans, have a little bit different down payment structure. They have different rates. They have different credit requirements. And so, yeah, we're going to talk about the difference between those and which one you might want to choose for yourself.
Perfect. Yeah. So FHA, the FHA stands for Federal Housing Administration, which means
hmm
they're more flexible, they're government backed. Conventional loans, which are backed by Fannie and Freddie, they will offer you, depending on your credit, income, maybe some better rates. We'll
Yeah.
talk about each. So let's talk about the features of each. So
Yeah.
you mentioned credit score. That is a big reason why we as loan officers might direct somebody to an FHA. What's the big
Mhm.
difference there?
Yeah, so if you look online, you're going to see that a conventional loan can go down to a credit score of 620. Technically, on paper, it can go down to 620, but you have a lot harder time getting approved if you're at that 620. You really want your credit score to be about a minimum, if we're going conventional, about a minimum of 680. Really up above 700 is where we prefer to see it if we are going conventional. However, with an FHA loan, you can go down to 580. Now, that has the same kind of caveat as the conventional. 580 is where we can get you approved. You really want to be above 620. And the
Okay.
sweet spot for an FHA loan, if you're preparing your credit, is somewhere between about 640 and 680.
Okay.
You're going to have great rates at that credit score. You're going to have minimum down payments at that credit score. You're going to have an easier underwriting process at that credit score, and so it just is an easier loan to do if your credit score is there. But FHA, you can go down to 580.
Got it. And then, one of the big factors we look at when reviewing a file is debt to income. What is the difference from a debt to income requirement from an FHA loan to conventional?
Yeah, so FHA loan will go, if we're using the automated underwriting system to get you approved, will go up to 57%. So that's all of
Okay.
your debts, minimum payments on credit cards, minimum payments on your car, minimum payments on health bills or medical bills, minimum payments on all that, plus the new principal and interest, taxes, homeowners insurance, and mortgage insurance on the new debt or the new home has to be under 57%.
Got it.
With a conventional loan, it has to be under 50%. However, remember when I said you wanted to have your credit score above 620 on an FHA loan?
Yep.
To get that 57% debt to income ratio, you have to have a credit score above 620. If you're below 620, you have a different debt to income ratio that's much lower. And so it does limit the amount of home that you can qualify for. While we can still get you qualified under 620, it limits the amount of home you can qualify for by going with a lower credit score on it. But it's still an option.
Got it. And then for those that are maybe in a tight spot or maybe close to that sweet spot from a credit rating, we talk to borrowers all the time, like, hey, let's look at how we can improve your credit. Could you talk a
Mhm.
little bit about what we have as far as a resource at our fingertips to help people
Mhm.
maybe bump up and get into that sweet spot you talked about?
Yeah, for sure. So we have what's called a credit repair program. We have two different versions. If you're below a 570, we have one type of version. That's a paid service that you go through a third party company. They can help you get your credit score up a good bit, and it takes 3 to 6 months. We
Okay.
also have a short term service if you're above 570 that we can do before you go under contract on a house or even after you go under contract on a house. Now, we prefer to do it before because you're having to track down letters from some of these creditors, and
Yeah.
it's a lot of paperwork that you might not want to do when you're in the middle and already have the stress of being able to purchase a home. But we can and have the ability to do it in the short term. Basically, what they do is we look at your credit and we run it through an algorithm, and it tells us, hey, if you pay this card off and if you pay this card down to a balance of $5 or $10, if you open up a new credit card, sometimes that's what you have to do. But they give us a list of all the things that need to be done. We give that list to you. You get those things done and get the proof that it's been done. And then they can go in and simulate a new credit score for you and what it would be because you've done those things. So we've seen people go from a 570 up to a 630. We've seen people go from a 660 up to a 720. Like, we can get a good bump in your credit score going that way. And definitely, if somebody's below 620, we're looking for options to get them above that 620 so they can qualify for that larger home that they're probably looking at.
Got it. So yeah, great resource that we have here. If you're close, if you're like, hey, this credit rating system is a black box. I don't know where to start.
Mhm.
I don't know what I need to address in order to get my score up. Talk to your
Yep.
loan officer here at Pure Funding. We'll figure out based on where you're at and where you need to be what the best path is, and try and get you those points. So we're up into a better sweet spot from a rate perspective.
Oh yeah.
So
Well, and also if you come into money and you're like, well, I'm just going to pay everything off, that isn't always the best either.
yeah,
So if that's something what you're wanting to do, let us look at it, because it might be, hey, three of these cards need to keep a balance on it.
yeah,
Small balance, but still need to keep something on it because they're going to hit you negatively for paying them off in full. So
it's a very
yeah,
good
we
point.
we'd love to look at it.
Whatever you think might make the most sense doesn't always make the most sense. So talk to your loan officer. Let us leverage the solutions at our fingertips to help you there. And
Yeah.
so, Willis, when you were talking about debt to income, there's
Mhm.
a word you used in there that plays a big part in the difference between FHA and conventional. Well, it really applies to both, and that is mortgage insurance.
Mhm.
Can you talk about mortgage insurance and how it differs from an FHA to a conventional?
Yeah. So conventional, let's start there. So conventional, you have mortgage insurance that is a calculation based on your credit score. It's based on your down payment. It's based on your debt to income ratio. It's based on a lot of factors. And you can go away and not have to have mortgage insurance if you put 20% down. So you often hear, well, I can't do a conventional loan because I don't have 20% to put down. You only have to have 3% if you're a first time home buyer, and you only have to have 5% if you've already bought a home before and owned a home in the last 3 years. It's just you're going to have mortgage insurance on it. Now, you have a really high credit score. You make good money. That mortgage insurance might be only $40 a month, might be
Yep.
only be $50 a month. Now, you have a low credit score and your debt to income ratio is above 45%. That can be $400 a month on a conventional loan. Conversely, if you're looking at, man, I've used that word twice now. Comparatively,
Comparatively.
if you're looking at an FHA loan, though, an FHA loan has a flat mortgage insurance. It's just a percentage of the loan amount. And that is going, in some cases, it's going to be a lot less, depending, especially if you have lower credit. In some cases, it's going to be more than conventional if you had higher credit. The thing about an FHA mortgage insurance is that it's on your loan for the life of the loan. Whereas with a conventional loan, once let's say you put 5% down, once your debt to or your loan to value on that loan gets below 80%, mortgage insurance goes away on a conventional loan. FHA loan, if you're only putting down the minimum amount of 3.5%, that mortgage insurance is on that loan for the life of the loan. You could have a 50% loan to value and
Doesn't
been
matter.
paying on this for 15 years. You still have mortgage insurance on there. The other thing about an FHA loan, they're riskier loans. And so how they compensate for that is that you have an upfront mortgage insurance payment as well. And that's 1.75% of the loan amount. So if you're doing a $400,000 loan, take 1.75% of that loan amount, and you have that added fee with an FHA loan that you don't have with a conventional loan. Now, because of that, the best part about FHA loans that so many people focus on, why so many people do it, because you're paying that upfront mortgage insurance, they can give you a lot lower interest rate. And so most of the time, on the high end, an FHA rate is going to be a full percent lower than what your conventional option would be.
Yep.
Right? So if I'm quoting 6.5 conventionally, FHA might be 5.5. Not all the time is it a full point. Maybe I'm quoting 6.5 conventionally, maybe FHA is 5.75.
Yep.
But it is going to be substantially lower than your conventional loan. And that's the thing that gets most people into wanting to do an FHA loan is it does have a much lower interest rate. But just remember, there's many things that go into that payment. If your mortgage insurance is higher with FHA, maybe a slightly higher rate conventionally might be something that you want to go with because you have lower mortgage insurance that way, or you don't have the upfront mortgage insurance payment. And so there's a lot of things that your loan officer is going to look at on which of these is better. And just because the FHA might have the shinier rate doesn't necessarily mean that it's better.
The best option. Yeah.
Yeah.
And I think this addresses the big question we got. I don't have the 20%. I can't buy a home. Right. And I think that you explained it very well in that mortgage insurance isn't the end of the world. Right. And this is on your loan officer to help you understand what the differences are. Hey, here's my scenario. I'd like to know what is available from a conventional loan standpoint and FHA. Let's break down the math. Let's see, is it worth it for a lower down payment and having to pay some mortgage insurance? Maybe you are getting a much lower rate. Maybe it all comes out in the wash.
Yeah.
We just need to do that math to understand what's the best for you, and also what's the value of the cash that you have to contribute, you have to put in for the down payment.
Right.
And so that leads to the big thing, the big impact on a borrower's checkbook is the cash they need to come to closing with, the down payment amount. So you kind of hinted around that there are options both on the conventional and the FHA. Obviously, mortgage insurance is involved on a conventional sub 20% down. How low can you get with an FHA and conventional from a down payment standpoint, so people get an understanding of, well, like really I am in the game, even if I am looking at an FHA with some PMI mortgage insurance.
Right. So your FHA is going to have traditionally the lower down payment, 3.5%. So you're going to have, you can put more down on an FHA loan, but most people that are going FHA are going to put 3.5% down, which is the minimum down payment. The neat thing about FHA loans is you can also ask for seller concessions so that your title fees are covered, your underwriting fees, your processing fees, all your first year of homeowners insurance, all of that can be covered to where the only thing out of pocket going with an FHA loan is the 3.5%. So that's the big benefit for FHA, along with the fact that you can go with a lower credit score and you can go with a higher debt to income ratio. We do a lot of FHA loans that fall into that criteria, and they might even have a little bit more, but because of where their credit score is and their debt to income ratio, or the fact that they also need a larger seller concession, we might go more with that FHA loan to keep it at 3.5. Conventionally, you do not have to put 20% down. Minimum down payment if you've owned a home in the last 3 years is 5%. There's definitely benefits to put 10% down if you can swing it, but the minimum is 5%. 20%, the mortgage insurance goes away, and that's why people think about that. But we also have programs with conventional loans. Maybe you have a good credit score. Maybe you're making good money, but you don't have a lot of money saved up.
Yeah.
You can put as little as 3% down for a first-time home buyer on a conventional loan. And if depending on where you live and the purchase price of what you're buying, we even have some programs where you can put as little as 1% down and get a 2% gift from the lender for your down payment. So you do get that 3% down payment, but you only came to the table with 1%. And so that's a great option too. That doesn't apply to everyone, but that's why we have loan officers to be able to help figure out which program works best for you. So there's a lot of options. Both are really good programs. We do a lot of loans, conventionally and FHA, and it's really kind of picking through and figuring out which one works for the borrower best, because not everyone falls into the same category on why they should go with one over the other.
And then on the 3.5 for the FHA, is that tied to first-time home buyer? It doesn't matter.
Doesn't matter. We also have down payment assistance with FHA programs as well, depending on where you live. And so those are an option as well for you. And that's that 3.5%, you can get a gift for to cover that as well. If not a gift, but a grant. To cover that as well. Now, if you do that, typically it's a higher interest rate, and typically if you sell your home or refinance it to a lower interest rate within 3 years, then you have to pay back that grant. So we want to talk about other options as well, and kind of save that as a reserve instead of, hey, I want to hold on to my money. Well, maybe that's not going to be better for you in the long run. So let's use some of that savings to get a good down payment for you and get you into a program that's going to save you money over time.
Awesome. Great stuff, Willis. So hopefully that gives you a good overview of the difference between an FHA and conventional loan. We talked about down payment, credit card, debt to income. We spoke about mortgage insurance, which isn't the end of the world. So hopefully this gives you a good idea of what the differences are. As always, we recommend getting in touch with a loan officer. Let's run your scenario. We're a broker. We have multiple lenders we can go to price your loan. And let's just generally figure out what makes sense for you at the time you're looking to buy your property. Willis, as always, thanks so much for the information. We really appreciate it. And thanks everybody for tuning in. We hope this is informative. Smash that like button, give us a subscribe, and Willis, we'll see you on the next video. We appreciate it.
Bye, guys.
Take care, everybody. Have a great day.